process.
You were just delighted that 3 people decided to show up in this.
I think this is all we're gonna get.
Anyone?
This is all we get. We might just call it. Got a couple on Zoom already.
That one's probably gonna start filling up too.
I don't blame them.
Hey, there's one of 3 minutes. 2 of 3 minutes.
Hey Eric, how's the audio on Zoom? Can you hear me okay?
It's good.
Going through my flashcards. This one is not you.
I guess I haven't given you.
Oh, well, how am I gonna put a face with the name or a name with the face if I don't have a flashcard? It may be worth the 10 points just to stay off my radar. I understand that strategy too. It's only 10 points. You don't have to do it. I'll never remember you. That's fine. And then I'll never call on you
Yeah,
either.
that's what I want to make.
That is hilarious.
Just, I'm gonna pass on the whole opportunity. I respect that. Okay. Thomas, Sam, Matt. Do I have a flashcard from you? What's your name? Christian. Yes. Castellanos? Did I say that right? Okay, great. So what part of Berkeley Riverfront did your construction company do?
We handled the membrane installation of the roofing for a couple buildings right next to Barkay.
Okay, cool. That's in down there. That's a neat area. Fun part of town to hang out in. Okay, Zoom crew, we got sound. It's 5:31. Let's do this. Let's do this. Tonight, we are going to be talking about intercorporate, intercompany transactions. Yes, Matt.
So before we jump into that, for the test too, over modules 5 through 8, is that officially open, ready to go? The countdown has started.
It's officially open, ready to go. The countdown has started. I thought I put out a notice over Canvas.
I did not
I
see.
don't know if I did or not.
And that's what I'm looking for, so that's the only.
Both with this notices there, not saying. Paid of the last one, but this one you haven't. Of the
Okay,
deadline.
let's do that right now. So let's go in here. This exam would be under module 8. There's exam 2. Let's look at edit timing. Exam 2 is currently open through November the 8th at 11 9:59 PM. Right there. So 2 weeks from tonight, you take that. So you got plenty of time to take exam 2. And be open through the 8th at midnight. Go out there, queue it up just like you did the first exam. You will have 120 minutes to take that 40 multiple choice questions. Be just like the first one. So thank you for that. So tonight's one of those lectures that we're kind of on the shoulder of what you all will, retain. Maybe that's why we have a light attendance tonight. People are thinking, I gotta get that exam 2 out of the way before I put anything else in my brain. Okay, questions? Questions on the exam, questions on the homework, questions on the research project? Well, intercorporate investments, let's talk high level before I just dive into a lecture on these PowerPoint slides. Anybody get a chance to look ahead, read the module? What are intercorporate investments? What are we going to be talking about tonight, high level? You have some idea of what an investment is. That first term, intercorporate, is exactly what it sounds like. These are investments between corporations. So when your research project, the company you're working on, whether that's Ford or Budweiser or IBM, sometimes they'll have extra cash sitting on their balance sheet and they want to put that cash to work. So they can put that cash to work just like we do as investors. They can call their banker and buy other shares of publicly traded companies. And you have an intercorporate investment. Now, when you all won't be surprised to hear that there's a unique accounting treatment associated with that. That's why we have a whole module devoted to it. So what I just described is an intercorporate investment that's traded in the public markets. That's easy. We know what it's worth. And the accounting is very simple. We use an accounting methodology called fair value accounting. Somebody describe fair value accounting. It's just like I can't think of another instance where we would have covered fair value accounting in this class. So let me sketch it out for you high level. Because these investments are publicly traded, we know what they're worth. And because we know what they're worth with a high degree of certainty, we're going to adjust their value on our balance sheet on a quarterly basis. And that's called fair value accounting. We just adjust the value of that asset, the investment in this case, on the balance sheet to whatever it's worth in the publicly traded markets. No different than the number that's adjusted on the bottom of your Fidelity statement when it shows up in the mail at the end of the month. The number changes. This is the exact same process. The number changes and we post it to our balance sheet. Now, you all know there's only one way that can happen. We have to run any change in that number through the income statement. So we're going to book a gain or a loss, an unrealized gain or a loss associated with that fair value account. Pretty simple. Another intercorporate investment that we're going to be taking a look at tonight are investments in privately traded companies. So the notation there, as you'll see here in a minute, is level 1 or level 2. So level 1, publicly traded, easy to come by. Level 2, a little bit more challenging. We're going to have to employ some of those techniques that you've probably used in a finance class when you're asked, what is something worth? So has everybody taken finance, first finance, maybe an introduction to investments? Yeah, most. Okay, a lot of head nods there. So, theoretically, something is only worth the future cash flows that it generates. This is our opportunity to put that skill set to work. Maybe we use a discounted cash flow analysis, and we as auditors, so this is exactly the type of thing you'd use in that M&A type of job. You come to some determination about what something is worth. And you might even, if you're auditing intercorporate investments, have to employ some of the skill set to put a number on that value. And then you would mark to market it. You would use that fair value accounting again to book that gain or loss on a quarterly basis and actually update the balance sheet. So we're gonna look at that process tonight, and then we're gonna go in and take a deep dive into the accounting associated with different levels of investment. Fair value accounting is usually associated with investment levels that are less than 20%. We're going to use a different accounting methodology when we own 50% or more of a company. Actually, it's 20 to 50. We'll use a methodology called equity method. And then when we own more than 50, when we have more than 50% of the voting shares outstanding and we can substantiate control, we're going to use the methodology called consolidated accounting. And I think this has come up several times in this class already this semester in looking at the income statements and balance sheets of your research projects. Some of you have noticed a line called minority interest. Minority interest arises when we use consolidated accounting. We're going to take a look at that too. Okay, let me see if I can enlarge this a little bit here. Okay. Okay, there we go. First learning objective, examine and interpret marketable securities reporting. One thing I want to do is remove all these animations. I think these animations. Set up slideshow. Show without animation. Okay. Okay, why would company A want to make a strategic investment in company B? The example I gave a moment ago was just to put their cash to work, but our authors give us a handful of various reasons why company A might want to make an investment in company B. One of the most common are strategic alliances. Maybe you're trying to consolidate enough shares to take over company B in a merger takeout scenario. It might even be a hostile takeover scenario. Targeted projects, market penetration, vertical expansion. These are all reasons why you might seek to make an equity investment. If you're lucky, management will forecast their intentions and give you some insights into the competitive strategy that surrounds that. If you're not, if you don't get that, you might, after you graduate, go to work for a private equity company, venture capital company, other M&A type of consulting firm, and you would strategize about who's out there in the market that would make a good strategic fit. And if you're a banker, you might pitch some of these to their competition. It might be your job to go out there and sell this M&A activity to other potential buyers. Those would be some common examples of how this all unfolds. This is a great slide detailing the 3 different methodologies that we're going to be looking at tonight. And it starts with level of control. If we have control, you go straight to consolidation, and that's 50% or greater. It can occur at less than 50%. I wouldn't concern yourself with that, but it can occur at less than 50% depending upon the different share classes outstanding. Sometimes if you read the fine print, the certain situations arise where, like if you have 2 different share classes, share class A and share class B. We invested in a company called IDT Telecom about 15 years ago, and the company was set up such that share class A had 12 voting rights for each share, and share class B had 1 voting right for each share. And the management team did that because before they went public, it was a consolidated entity and largely controlled by the founder, and the founder didn't want to lose control of the business, so they established these multiple share classes. If you're looking at a company that has multiple share classes, go back to the proxy so that you can understand the rights and privileges associated with the various share classes outstanding. If you have preferred equity, do the same thing, because preferred equity is nothing more than just a contract between the issuing company and the investor that buys the preferred equity. And you can have hundreds, if not thousands, of different provisions and privileges that position that investment senior or junior in the capital structure, and you need to be able to understand all that. If we have no control, then we're gonna use fair value accounting or the equity method of accounting, depending upon that level of control. And that level of control breaks down like this. If it's less than 20 or we have little or no influence, then we're gonna use fair value accounting. If we have significant influence of between 20 and 50% of the voting shares outstanding, we're gonna use the equity method of accounting. And then if we control the business, we're gonna use the consolidated method of accounting. This is the whole lecture right here on slide 6. If you come away with nothing else from tonight, just tear slide 6 out and start and make sure that you have, it's an open book test, right? So have this one at your fingertips. Like we can draw a lot of questions from this slide. It covers all of the accounting, it covers all of the thresholds, it covers all of the distinctions and differences between the accounting. And if you look at the individual statements, we can see the balance sheet, income statement, and cash flow effects associated with each type of accounting. And we're going to look at an example of each, so I won't dwell on this slide, but star it, come back to it, have it hyperlinked, and ready to go on the day you take the exam. Passive securities, and what's a passive security? This would be little or no control. That's what the term passive means here. We're not trying to be active in our ownership of that company. We're not trying to exert our influence, or use our shares to sway the competitive positioning of that company. So when we have a passive investment, we're going to draw a distinction between marketable and non-marketable securities. And the transaction breaks down pretty simple. It's fair value accounting, like I just mentioned. So on a periodic basis, we're going to book a gain or a loss on the sale. And that's a very simple calculation. Proceeds from sale minus book value of investment sold. That transaction is when it's actually sold. In between time A and time B, when it's sold, we're going to mark to market that asset on our books and book an unrealized gain or loss. But before we go there, let's look at the simple transaction. Assume that Alphabet purchases 1,000 shares of Juniper Networks for $20 cash per share. Subsequently, they sell that. They sell 400 of the 1,000 shares for $23 per share. So they've just booked a $3 profit on the 400 shares they sold. So there's a $1,200 profit in there. So initially, always identify cash going out the door. We're going to credit cash for $20,000 and we're going to debit marketable securities for $20,000. Fast forward to transaction number 2 on the sale date. We're going to debit cash for $9,200 and credit marketable securities for $8,000. The difference there being our gain on sale of $1,200. Pretty simple transaction. Not much different than any other asset we would put on our books. Okay, I differentiated for you a moment ago securities that fall underneath this level 1 categorization. Level 1 are securities that have a clear publicly traded quote. So you can look at the Wall Street Journal and get their quote, or log into Yahoo Finance and you're going to see the publicly traded share price of Boeing or Coca-Cola or Microsoft. Level two, these are typically private institutions. They're model-based. We're using a discounted cash flow, a peer group analysis, or other similar techniques based on observable data. And then level three, we have no observable inputs. So the valuation is supported by little or no market activities. As is the case every time we meet, I encourage you to go to the 10K filing and look at the fine print. So you go back and you look at the footnotes. There's going to be tables associated with any intercorporate investments that your firm has made. And it's also going to be disclosed what level they are. If you're looking at a business that has a lot of these level three assets on our books, well, how are those being valued? They're going to give you some insights into how they're valued. But you know, as an analyst, based on the fact that they're level three, this is pretty murky territory, which means that there's opportunity for you as an analyst to differentiate yourself. If you really dig in, you might find some discrepancies between what the balance sheet says those assets are worth and what they're actually worth. I don't remember the story perfectly clear, but this is probably 40, 50 years ago now. There's a story about Ted Turner amassing a huge swaths of real estate. This was before fair market value accounting was in wide practice. And a number of analysts employed the skill set that we're talking about right here. They took a look at those balance sheets and they recognized that that real estate was booked at a certain price. Then they went out and looked at the real estate and some comparables of land that had sold adjacent. And what they found out was that when you added up all the real estate on the books, it was worth a factor of 15 or 20 times greater than where the share price was currently traded. So ding, 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 alarm bells start going off, and these analysts, they were smart enough to recognize value when they saw it, and they started accumulating some of the shares. Those opportunities are still available today. They're a little bit fewer and farther between because we have implemented fair value accounting in many respects, but this is where you'd look if you wanted to find something similar, and it's out there. So take a look, find out what assets your companies are reporting in that level three category, and then find out how they're valuing them, and put your analyst hat on and think with some level of common sense about how you might be able to make an end run at what those are worth from a different perspective. And you might find that you're able to draw out some insights there. Okay, so here's the adjustment. We looked at the sale a moment ago. Now let's assume Alphabet's investment in Juniper Networks increases in value to 25. So we bought it at 20, it increases to 25, but we're not selling it. At the end of the reporting period, we have to adjust the value up. It's worth 25 now. The balance sheet needs to reflect that it's worth 25. So we still have whatever it is we have. The authors do the math for us. That increase from 20 to 25 results in a $3,000 unrealized gain. So we're going to book the marketable securities directly. We're going to debit that $3,000 gain to marketable securities. So the balance of that account on the balance sheet is going up by 3,000. And then the offsetting credit flows through to the income statement as unrealized gain. That flows through to net income, and net income posts to retained earnings. So our earnings per share are affected directly by that increase in the marketable value of those securities. So you may want to take that into account. Some companies, Apple is one of them, Apple implemented a huge dividend program, so they don't have the problem. The problem today is not as big as it was, but 5, 6, 7 years ago, Apple had become so profitable that they had accumulated, I don't even remember what the number was, 50 billion, 60 billion, $70 billion in cash that's sitting on their balance sheet. And the analyst community wanted to know, what are you going to do with that? Well, let's say you put it to work in the stock market, and the stock market goes on a big bull run. or a big bear run. Well, that's gonna result in a huge unrealized gain or a huge unrealized loss. That's gonna flow through to earnings per share. Earnings per share is the most common trigger to get your management teams paid. If you're sitting on the board of directors, is that how you want to run your company? And what I mean when I ask that is, most of the time, boards of directors like to set the tables so that management teams get paid when the decisions they make running the company turn out to be good decisions. Well, this is an investment decision, meaning they just put cash to work in the stock market, and the stock market does what it does. It goes up, it goes down. It doesn't really have anything to do with the management prowess of the person at the helm of the company. So you might be so inclined to factor something like that out. I share that example because you see these types of shenanigans all the time. When managers know that these earnings are going to flow through to earnings per share, and they know where and how to play that game of find the penny, sometimes they'll move money into the market, sometimes they'll move money out of the market. If they're behind the quarterly number a little bit, they might get a little bit more aggressive with some of these moves. Another big place that you see this, and we'll talk about this again in, I think it's module 11, when we get to the accounting for defined benefit pension plans. So defined benefit pension plans are the money that we pay retirees sometimes for the next 30, 40 years. Well, you can imagine how those liabilities accrue on the books of Fortune 500 companies. Sometimes those liabilities are 10, 20, 50, 60, 70, 80 billion dollars. And typically they have an offsetting investment account that's been set aside to fund those liabilities. Well, those investments are in the market. If you got an $80 billion investment account, largest defined benefit investment account, I think, is Boeing's, and it's at about 130 billion. You got a $130 billion account, the market goes up by 10%, you just made $13 billion. What's that do to your balance, to your income statement? $13 billion gain looks pretty good through the net income rate. We have, as you won't be surprised to hear, we have special accounting for that instance. Talk about that in module 11. The point is, once you understand the accounting, you can start thinking through all of the different opportunities that management teams might have to deploy resources to take advantage of that accounting. So think about that with a skeptical eye. Oh, let me go back there. This is an example of the table I want you to look for in your 10K file. This is disclosed by Alphabet. This comes out of their 10K filing. You'll see here as of December 31st, 2018, they list their level 1 and level 2 securities. It doesn't show any level 3 securities on their disclosure. Prior to January 1, 2018, we didn't have the same accounting treatment. What did we have? I think it was January 1, 2018, the new regs required the mark to market. So now we have the posting of unrealized gains and losses. The point of this slide is you all have to do a historical analysis on the profitability of your companies. So find out what their accounting treatment was in 2018 so you know you're comparing apples to apples. Fingers crossed, your management teams will have presented you already with pro forma numbers so those can be comparable across time. If they haven't, and the company you're looking at has big intercorporate investments, you might not be able to compare numbers from 2019 to 2018 without making an adjustment on your own. I doubt it'll come into play, but take a look. Okay, we've been talking about equity securities. Let's shift gears and talk about fixed income securities. So this is fixed income in in one respect is more common because that would include like treasury bills and CDs and money market funds. That's the most common opportunity to put cash to work. You know, let's just earn a little bit of a higher yield on the cash that companies have on their balance sheet. It happens all the time. And that's easy to account for. In some other instances, you'll catch management teams investing in the publicly traded debt instruments of other companies. So this could be Ford buying the publicly traded bonds of GM or one of their suppliers. That's common. It's a little bit more complicated because now you have to take measure of things like the change in fair value from one period to the next, because publicly traded debt instruments do change in value from period to period. And we have various classifications of fixed income securities. We have held to maturity. So these are fixed income obligations that your management teams have said, we're going to hold that to maturity. We don't intend to trade it. And therefore, we don't have to worry about its changes in value from one period to the next. We're going to buy it. We're going to put it on our balance sheet at book value. And we're going to record the income on that fixed income security as income on our income statement. And we're not going to worry about it until it comes to maturity. We have available for sale securities. These are a little bit different. It's a quasi category where we might sell it, we might not, we might hold it to maturity, we might not. We are going to mark to market these. We are going to adjust these to reflect fair value on a periodic basis, but there's a wrinkle, and I'll get to that. And then lastly are trading securities. These are intended to be traded. We might hold these a day, we might hold these a week, we might hold these a month, but because they are intended to be traded, we are going to mark them to market, just like we reviewed a moment ago for the equity. All those transactions we just reviewed are identical for trading securities. Okay, who determines, this is a key question, who determines whether a fixed income security is held to maturity, available for sale, or trading?
It's management.
Yes. And can you foresee any problems with that?
Yes.
Yeah, I ask leading questions, of course, yeah. I mean, when you have three categories and the management teams think to decide which category you're gonna employ, the temptation is always gonna be, oh, well, that bond is this when the accounting treatment works in my favor, but when it doesn't, it's this category. So now you, as the analyst, and hopefully you're in good company and the auditors are looking out for this too, but remember the buck always stops with you. It's your job to come to the determination about whether or not these numbers are accurately reflecting the fundamental underlying economic truth of the matter. So it's your job to take a look historically at whether or not there have been fixed income investments bouncing around from category to category. Take the same investment and it's trading this year, held to maturity next year, and available for sale the year after that, you got a big problem. And as with everything else, there's going to be a table in the back of the 10K filing detailing all the securities that are owned and their classification. So you can look at this year's 10K compared to last year's 10K and compared to the year before that, and assess some trend, if there is. Okay, held to maturity, I talked about that. We're going to record those at fair value. And then on a periodic basis, we'll look at the income, but they're never adjusted for changes in market value. Available for sale securities. We are using fair value accounting on available for sale securities, but we are not running the changes in the valuation through the income statement. So we're going to talk about this category of income several times tonight. It's something called other comprehensive income. And I'm curious how many of you have run across other comprehensive income in a prior accounting class or finance class? Anybody? Okay, a few of us. Okay. I think of other comprehensive income as this category of income that FASB takes issue with. There's something about it that's unusual or peculiar in nature, and therefore FASB wants to set it aside. And they do that to make the income statement more useful on its face. So the most common reason for treating something as other comprehensive income is that it's so volatile that removing it from the income statement gives the user of the income statement more information about the true nature of the business. But then we're still going to disclose this income on a separate statement called other comprehensive income. Or sometimes you see this presented in a consolidated manner where the income statement will start just like it always does with revenues, less cost of goods sold, less selling and general and administrative expenses, less research and development equals earnings before interest and taxes, less interest, less taxes equals net income. Then that's the bottom line. Except net income is not the bottom line. There's something below it. And what comes below net income is this other comprehensive income. So I like to think about that as accountants saying, get down there in the basement. This is the basement of the income statement that they don't want you to look at, and they call it other comprehensive income. One of the categories of other comprehensive income are the mark-to-market adjustments associated with available for sale fixed income securities. Available for sale securities are by definition fixed income securities. So you have identical fair value accounting. You have identical recognition of unrealized gains and losses. We're just going to push those losses into the other comprehensive income section of the income statement. Okay. Any questions about that? You can interrupt me at any time. Yes.
So you said that comes after taxes and interest and all of that, so how does that affect it? Like, you know, why aren't taxes being taken out of other comprehensive income?
It's a terrific question, and I'm gonna give you a half answer. And then I'm gonna give you a full answer in 2 weeks when we talk about the full accounting for taxes, unrealized tax deferred liabilities and tax deferred assets. Because all companies keep two sets of books. They keep one set of books to satisfy GAAP, generally accepted accounting practices. They keep another set of books to satisfy the IRS, because the IRS has all kinds of rules that are not consistent with GAAP. And anytime these rules don't line up, they create a deferred tax asset or a deferred tax liability that we have to keep track of. And it's one of the most complex areas of accounting that I think it's complex. I get confused every time I teach it. So you'll get to see that. And we have to reconcile those two books on a quarterly basis. So all of this will create a deferred tax asset or a deferred tax liability. And that'll get reconciled. So that's the part of the answer that I'm going to defer. With this particular treatment of available for sale securities, we don't have to worry about the tax consequences because they don't have any tax consequences because these are unrealized gains or losses. When they become realized, if we were to actually sell this and create a cash event, that transaction would be promoted and recorded on the income statement. Tax consequences would be shown and accrued for and paid. And then this transaction that had previously affected other comprehensive income would be reversed. So good question. Yeah, but that deferred tax assets and deferred tax liabilities, that's a fun one. Here's another example of the disclosure that you're likely to see if you go hunting, when and if you go hunting for it in the 10K. And here's an example of the reclassification. So the disclosure that Alphabet gives us shows net income, other comprehensive income. There's another category that we'll look at tonight called change in foreign currency translation adjustment. That posts to other comprehensive income. Here's the available for sale investments, changes in unrealized gains. Then we're going to subtract the reclassification adjustment for net gains, losses included in net income. So this is an event where we've actually gone and sold an available for sale security, and we have to reclassify that from other comprehensive income to net income. Look for this schedule in the back of your 10K filing. It gives you all the detail on how those are categorized. Okay, analyze and interpret equity method investments. We're going to take a look at the accounting for equity method investments. Equity method was a percentage ownership between X and Y. You recall what it was at the top of class? When we own between 20%, but not more than 50%, we're going to use the equity method of accounting. So this is a little bit different from the fair value method in that we don't record something at what it's worth. We record something at its book value, just like we would if we actually owned the business. So if we bought another business, we would record all of the assets, all the liabilities. What we would be left with is the book value of the business. Assets equal liabilities plus owner's equity. And it's that owner's equity, which is the book value. So the equity method teaches us as analysts to think like business owners. And we're going to record this investment on our balance sheet as if we actually owned it. So it goes on there at book value. And then on a periodic basis, we're going to book our fair share, our fair proportional share. We own 20%. We're going to book a 20% of their net income. So we buy an interest in company XYZ. We own 20% of company XYZ. And the following year, they earn $1 million. We're going to book net income of $200,000. That's our proportionate share. So that's going to flow through to our income statement, and we're going to call that income from investment in XYZ. And then our investment in XYZ is going to go up by that much.
Is that a realized gain that you pay capital gains on, or is that unrealized?
Great question. And there again, it's a little bit of both. It's not a gain, it's income. We treat it as income. So it would be taxed as if we owned a fixed income investment that had just given us a dividend check.
Okay.
But let me draw another distinction, because when we record our fair share of somebody else's net income, we're not actually getting paid cash. That business, well, what do businesses do? When they earn net income, when they have earnings, then the management team will get together and they decide for themselves how they want to spend those earnings. They can hire new sales associates. They can invest in technology. They can go after mergers and acquisitions. You can spend those earnings in a lot of different ways. None of what I just mentioned sends cash back to one of your owners. It only sends cash back to one of your owners if you get around as a management team and you say, we need some distributions. We need to take some money out of this company. And in the corporate world, the nomenclature for that is we need to issue a dividend. So if in that event, a dividend, a cash payment would go back to the investor. And that dividend, because it's a cash payment, is taxable. The proportionate share of income is a non-cash payment, and it's a non-taxable payment. Both of those will result in discrepancies between GAAP financials and IRS financials, and that will in turn create deferred tax assets and or liabilities on your balance sheet. Okay, let's look at an example. Hopefully this will clear it up a little bit. We're looking at Alphabet or Google here again. Let's assume they acquire 30% interest in Middle Networks for $300. Middle's balance sheet reports $1,000 of stockholders' equity. Okay, simple enough, simple math. We own 30%. They have a book value of 1,000. Our value is 300. So Middle reports profits of 100 and pays 20 in cash dividends to its shareholders. 6 of that would go through to Google based on their proportionate interest. So the first transaction that we need to make is our purchase of 30% of Middle. So we got 300 in cash going out the door. That's going to be our credit. We got 300 that we're going to debit, and we're going to call that investment in Middle. No different than any other asset that we're showing on our balance sheet. The second transaction that we need to record is the income. So Middle at the end of the first period reports, what was it? $100 in income.
30% of share.
Yes, Google's fair share of that is 30. So our investment in Middle is going to go up by 30. And then we're going to book equity income. That is the journal entry that we're going to make that will show up on our income statement. And that's going to flow through to retained earnings. In the next transaction, Middle pays $20 in cash dividends to Google. So this is a cash transaction. We have cash coming from Middle to Google. These are dividends that are being distributed. Our proportionate interest is $6. So our cash account is going to increase by $6. And this is important. Our investment in Middle goes down. We're treating it as a business that we actually own. So when they send cash out the door, that makes what's left, that makes the business that's left less valuable because they are now worth precisely $20 less because they just sent $20 out the door. They don't have any. So when they earn money, our investment in Middle goes up. And when they distribute funds via dividend, our investment in Middle decreases. Keep track of that period to period to period, and that will reflect the current value of any investments that we have underneath the equity method of accounting on the 10K file. Okay, slide number 27 basically shows the same graphic we just went through. Okay, we looked at a very simple transaction where the book value of the company was equal to our percentage interest, but it rarely occurs like that. The book value of the company is usually a fraction of what the company's actually worth. And that's as a result of goodwill and other intangible assets that don't always show up on the balance sheet. If you look at Apple's balance sheet, their book value is, a very, very small fraction of what that company's actually worth because they've been able to build up so much value in their brand over the last 20 years. So here's another example where Google pays $400 for its 30% stake in Middle. 300 of it is an equity investment because that's what Middle's book value is. So 300 of that is investment in Middle. And then we would book the additional 100 underneath one of these three, maybe there's a fourth or a fifth, but these are the three most common intangible assets. So unrecognized depreciable assets, identifiable intangible assets, or goodwill. And you see goodwill all the time. Goodwill is kind of a catch-all asset, a catch-all denotation for any difference in book value and value that we pay through M&A or some other transaction. Okay, issues. Let's skip that one. Okay, here's a sneaky one, and this might show up on the exam as a multiple choice question and might show up on your homework as one of those longer questions that you actually have to work through with the math. Conceptually, what I want you to be aware of is that when we use the equity method of accounting, the investee's gross assets and liabilities are left off the balance sheet. So we're treating this as if we own it. We own a 20% interest, but we're only recording it as an investment in middle, to use that last example. We're not including middle's assets. We're not including all of their liabilities. So when we go to calculate a return on equity, we're going to get a return on equity that is a little bit overstated. So it's actually going to overstate the net operating profit margin, because here our authors tell us most analysts include equity income in operating profit, but it relates to operating investments. So the profit margin is going to be a little bit overstated. That's a nuanced point, but I wouldn't be surprised at all to see it come up again in a test question. So star that one. Similarly, your net operating asset turnover is going to be affected, although depending upon the asset and what's excluded from the denominator, the impact could be higher, could be lower. That's a little bit indeterminate. And financial leverage is going to be understated because we're not bringing any of those associated liabilities on the books. Okay, now I want to look at consolidated accounting, which is going to reconcile for all of those little nuances that we just looked at on that last slide, because with consolidated accounting, we are going to bring over all of the assets and all of the liabilities. Remember, we have control here. So let's think for a moment about owning 100% of the shares outstanding. If we own 100% of the shares outstanding, that's our company. Every share of that company is our company. We own 100% of the assets. We're responsible for 100% of the liabilities. Now, it might be ring fenced inside of its own LLC, which is a smart thing for companies to do because it insulates any liability, product liability, warranty liability, fiduciary, directors and officers liability. If they do something stupid running that company and they get sued, well, they can't come after the parent company if you've established these LLCs properly. So you see that a lot. And it's appropriate. So if that's the case, then what we're going to do from an accounting standpoint is add all of the assets of the subsidiary to all of the assets of the parent company. We're going to add all the liabilities of the subsidiary to all of the assets of the parent company and present one consolidated balance sheet and one consolidated income statement with total sales and total expenses.
So this is not an acquisition of the company you acquire 100% of. You still leave out their operating, doing its performing business, everything like that. Whereas
It could be an acquisition and still do it like you described. They're a separate but wholly owned company. So they have their own management team, they have their own facilities, they have their own operations. It's all distinct. They have their own brand. It's all one company. Like trying to think of a good example. Who owns Porsche? Does Ford own Porsche?
no, I think it's Volkswagen now.
Okay, so that might be a good example. Volkswagen would be the parent company in that instance, and then Porsche would be one of their subsidiaries. And Porsche has all its own accounting. They have all of their own distinct operations. You can sit down and have a conversation with the CEO of Porsche and talk about their global distribution strategies. But at the end of the day, they're owned by Volkswagen. So Volkswagen can do whatever they want with the company. They can allow them to continue operating as their own separate, distinct operating unit, or they could fold them in, rebrand them. Their assets are, I don't know if they're wholly owned. I don't know if they own 100% for the sake of this conversation. Let's assume they do. Their assets are wholly owned, so they get to determine what happens. Does that answer your question?
It does.
Excuse me. How we doing on time? Okay. How are we doing? We go till 6:45. Okay, so 20 minutes. We're on slide 35. Gotta make it through slide 70. So I'm gonna kick it into high gear here.
It's last time.
What'd you say?
I said we're ahead of the pace from last time though.
What I make it like 20% of the slides last time.
We were only on like 17 or 18 last time.
Yeah, but I got most of it in my high level yapping.
Absolutely.
Yeah, I can give most of these lectures without any slides. Yeah. Yeah, this is the slide I was looking for. Walks you through an example of exactly how we do the consolidation. And it's not that complex, especially when we own 100%. In this example, we're looking at two companies, Penman in column A and Nissim in column B. We're going to consolidate those over here in column B, and you see the consolidating adjustments in column C. And for the most part, you get simple math. $6,000 worth of current assets plus $1,400 worth of current assets equals $7,400 in current assets. But when we have the investment in Nissim, Penman made a $3,400 investment in Nissim. Nissim obviously doesn't have an investment in Nissim on their balance sheet. When we consolidate those, well, we're adding Penman plus Nissim. So we got to get rid of that $3,400 investment in Nissim. That doesn't make any sense when we consolidate the financials. But when we add all the assets and all the liabilities, that's naturally going to go away. So everything's pretty straightforward except for these consolidating adjustments. And as you can see here, the contributed capital, so this is equity, $10,000 in Penman, $2,000 in Nissim. Because Nissim is wholly owned, this doesn't make any sense. This is double counted. The only contributed capital or the only equity that matters is the parent company. They own the whole thing. So that's the only equity that really makes any sense on a consolidated financial statement. Same way with retained earnings. All of the retained earnings and consolidated at this point. So we're gonna bring those over here at 4,400 and make an adjusting entry for equity and investment down here. And you can see the rest of the consolidated entries flow through very smoothly. Now, what happens when we do not own 100% of the outstanding shares? This is the instance that's gonna cause that minority stakeholder line to show up on your income statement and balance sheet. And this is how it works. So you have the exact same methodology, only now the math doesn't work because we're only transferring over an 80% interest. So now we have to book this non-controlling interest so that our balance sheets will match. And then you see down here under the income statement, we have equity income from investment, got to factor that off. And then we add net income attributable to non-controlling interest at 20% amounts to $80 there in this example. So we've just created these two line items in reconciling that consolidated accounting. And that will give us some insights into how much of that balance sheet, how much of that income is attributable to the minority stakeholders. Now, later in the semester, we've already run into it a couple of times. What we're concerned about are the cash flows associated to common shareholders. We're taking the perspective of common shareholder in this class. So if we bought a share of stock on the public exchanges, we are not minority interest holders. So anytime that you're valuing a company, you're going to want to look at the value of that company to controlling interests, basic shareholders. Okay, our authors give us some good examples of that. I'll let you review a second, a third, and a fourth if you need it on your own time. And I will fast forward to the second example that our authors give us of other comprehensive income, which is translation gains and losses associated with foreign currency. So at the end of the reporting period, if we have operations around the world, we're going to have to present those in US dollars. So let's use McDonald's as an example. There are McDonald's franchises located all over the world, many in Europe. Those McDonald's franchises in Europe, they collect euros in exchange for hamburgers. And at the end of the reporting period, you're going to see sales and expenses and net income reported in euros. That does us no good as that does the CFO no good when he has to report numbers to the SEC. All of those numbers need to be in dollars, or investors and other interested parties are not going to be able to make any use of them. I mean, if McDonald's gave you probably 50 different income statements for every currency that they do business in, you could throw it in the trash. It would be of no value whatsoever. You have to translate that business. You have to translate all those sales back into something that's usable and comparable across periods and allows us to benchmark their performance against Burger King and Wendy's and ask educated questions of the management team and hold them accountable and manage the business. If you didn't do this, none of the accounting would be worth anything. So we have to do this. And as you can imagine, if you operate globally, this is a pretty big deal. Anybody know what's been going on with the dollar this year?
It's losing value. To most main currency.
Let's see if I can pull it up here. It's worth a look. There we go. There we go. Okay, look at that. This is what's happened to US dollars per euro at the beginning of the year, or if this is a 1-year chart. It took 0.85 euros to buy a dollar. Now it's parity. It's 1-to-1. Okay. McDonald's does a lot of business in Europe. I don't know. Let's make up some numbers. Let's say they do 100 billion euros worth of business. Well, a year ago, 100 billion in sales translated into 850, that's 1 billion, I can do that. 1 billion in sales translated into 850 million in sales if you reported that in US dollars. Right? What is it today? 1 billion in euro sales translates into 1 billion. Now, did McDonald's do anything different? They sold the same number of Happy Meals and hamburgers and French fries and McFlurries and everything else they do. Their operations didn't change a bit. They didn't sell any more product. The value of the dollar just went. So when they translate all of those sales from euros into dollars, at the end of the year, they just made $250 million out of thin air. Now, what happens to that money? Yeah, in a sense, it doesn't even exist. It's a translation adjustment. It shows up on paper because we just translated it. But in actuality, those euros are sitting in the cash registers and the bank accounts of those McDonald's franchises located in France and Switzerland and Italy and wherever else that are transacting in euros. So it's going to show up on the income statement as an increase in sales, but in a real manner of speaking, it doesn't exist at all because we just translate. So that's a very important thing to know as an analyst. and where it gets even bigger and more pronounced is that we just looked at sales, and sales happen in a 12-month period of time. We have to do the same thing for the balance sheet. And all of those franchisees, they own real estate and marketing collateral, and they own stuff. Real estate's the big one on McDonald's books. So it's just like all of those McDonald's franchisees, some of them are located in prime real estate locations. I mean, there's a McDonald's in Times Square. There's a McDonald's in downtown Paris. There's a McDonald's everywhere we go, and that's some of the most valuable real estate in the world. So how much is that worth? Well, it's all on their balance sheet, and it's all booked in euros. So now do the same thing. The value of that real estate could be $100 billion or more at the end of the period. We have to translate that back into dollars. That's a huge swing that companies like McDonald's can experience every year. This is actually a pretty outsized example of what companies are dealing with this year. But every company that has, this might be, I don't know how the market is going to interpret this. I think the market is smart enough to know how the accounting works. But I wouldn't be surprised if there were opportunity out there for anybody in this room to run a simple screen through Bloomberg for companies that have outsized exposure to translation gains and losses. Because when they translate their balance sheets this year back into US dollars, if US dollars is your home currency, you're going to get a huge translation gain. Now, if it's the inverse and your home currency is the euro, you're going to get a huge translation loss. That's going to work the other way around. Now, because these translation gains and translation losses can be so big, FASB says, make sure you put that in other comprehensive income. Get that down into the basement so that you're not creating huge distortions on the face of the income statement. We still want to report it. Still want to let everybody know where those gains and losses are coming from. Just don't push it through net income, because those can create a level of volatility that take all the use case out of the income statement. So yeah, very fascinating year for that particular little piece of accounting. And as with everything else, take a look at the disclosure in the back of the 10K. Here's an example of Alphabet's. You can see their accumulated other comprehensive income went from 992, I think these are millions, 992 million in 2017 to 2.3 billion in 2018. So that's some juicy reading to track down where those other accumulated gains and losses came from. Okay. Let's talk about a third category of other comprehensive income, which would be hedges. It's very common for companies to hedge. And they show up in a couple of different categories that our authors differentiate between. Okay, what is a hedge? This would be probably derivatives. Who teaches derivatives? Kuipers. Okay, so you've taken Kuipers' class.
I'm in it right now.
Okay, so a hedge is nothing more than an options contract, a futures contract, a forward contract that immunizes the movement, immunizes the price fluctuations of another asset. So if you're Southwest Airlines and you know one of your largest expenses on a periodic basis is the cost of jet fuel, well, you don't have to take on the risk of knowing whether jet fuel is going to be double the cost it is in 18 months versus today. You can enter into a forward contract that guarantees you the right to purchase jet fuel at $150 a barrel. That's called a hedge. We have specific accounting associated with hedges. There's two different types of hedges. there is. The next slide. There's a fair value hedge. And then there is a future cash flows hedge. So the fair value hedge is typically hedging marketable securities, fixed rate debt, other interest rate vehicles that are sold and or sponsored by a very large bank, and their assets. So we want to immunize against the change in the value of an asset or a liability on our balance sheet. That's called a fair value hedge. And as the name would imply, we're going to use fair value accounting. So at the end of the period, we're going to look at the value of that hedge. If it's gone up, we're going to book a gain, an unrealized gain. If it's gone down, we're going to book an unrealized loss. And that's pretty much the simple accounting point. If it's a cash flow hedge, like the one I just described with Southwest Airlines, then we put it into a different category, and those unrealized gains and losses will flow through to other comprehensive income. Cash flow hedges are a little bit less reliable. They introduce a greater level of risk. And this is something for you all to come to a determination on. Sometimes they can be used as nothing more than sheer speculation. And that's tantamount to a management team taking your money to Vegas. Might even be more aggressive than taking your money to Vegas, because if you don't have a hedge, but rather you have speculation, you're just betting on the price of oil or natural gas or whatever else you have issued that hedge or speculative position against. So when we see that, it will flow through to other comprehensive income. The accounting for that works just like translation gains and losses. So we don't need to look at an example. And okay. I want to talk about equity carve-outs. So equity carve-outs are transactions that you'll see periodically whereby management team want to get rid of a subsidiary, or they just want to downsize their company, or there was a big one in the news here not too long ago. Some company was breaking itself into 4 or 5 different pieces. What company was it? My brain's not working. It'll come to me probably right after class is over, and you would all recognize it. Kraft did this. Kraft macaroni and cheese. They did this a few years back. They spun off another operating unit called Mondelez. And Mondelez is a snack food business. So think Oreo and Pop-Tarts and graham cracker goods. Well, snack foods are one of the fastest growing categories globally. And because they're growing so fast and there's good margins associated with snack foods, they're awarded a higher multiple. So the thinking by management team was, we can spin off Mondelez, the market will recognize the value associated with that business, they'll award it a higher multiple, and the two companies apart from each other will be worth more than they were together. That's a dubious claim. Sometimes it works out that way. It can never work out that way with the economics, because you've just superimposed an added cost structure and regulatory business upon the same operating units. So that's why I call it dubious, but you get that advice a lot of times from investment bankers, because they earn a lot of money when you enter into these types of transactions. So that is what you think of as a carve out. And our authors identify several different ways of initiating those types of transactions. One is an IPO. You can IPO a distinct operating unit. You can say, we're going to sell this to the public, and you can sell that operating unit to the public in an IPO. You can spin it off. Spin-offs. Let me think of an example of a spin-off. It would be as if you logged into your investment account today and you saw ABC Company. And then you logged into your investment account tomorrow and you see ABC Company. And then you also see XYZ Company. And ABC Company just decided they wanted to spin off a second unit or operating unit. So they just give all of their investors new shares. in the new business. And it's not new, it's the same business that's been around for a long time, but now it's separate, it's distinct, it's got its own P&L and its own separately traded stock associated with it. This, when you see this, take notice, because it can be one of the most profitable investment opportunities that you'll ever come across. And as a matter of fact, if you look at the historical performance of stocks that are spinoffs, I saw one analysis go back 20 years, and as a group, they outperformed the S&P 500 by close to 20% a year. And that is as a result of mutual fund managers by and large. So I used to work for the Buffalo Funds. Imagine yourself managing a mutual fund. It's your job, you've been hired to run a large cap value mutual fund. Okay, all of your clients, pension funds, institutional clients, investment advisors, they've hired you to manage their large cap value portion of their asset. Great. Well, day one, you log into your account and you see ABC Co. And then the next day you log into your account, you see ABC Co, which is great. That's exactly what you want. But then you have XYZ Co. You have this other little spinoff. And if that business is wholly dissimilar to the one you bought, say it's a small cap growth company, a lot of times you see little divisions that are spun off. Well, they're spun off for a reason. They're faster growth. They're in a different industry. They're research and development intensive. They oftentimes don't fit the mandate that portfolio manager has been hired to fulfill. So what does that portfolio manager do? Well, if it's not consistent with their charter, if it's not consistent with what they've been hired to do, well, they just sell it indiscriminately. You know, it's a nuisance, just sell it. And that is a pattern with spinoffs. So what you typically see 2 to 8 weeks after the spinoff is initiated is so much forced selling pressure, the stock price will decline by approximately 20%. And that stock price decline is uneconomic. It doesn't have anything to do with the business. It's just investors selling because they don't, for uneconomic reasons. That's your opportunity. That's why that universe of spinoffs as a whole has been able to outperform the S&P 500. But you have to time it right. You got to wait for that 2 to 8 week period where they've experienced the decline in stock price. And that's when you step in and swoop it up and make some money up. Okay, spinoffs, split offs, those are basically the same thing. And IPOs. So take a look at those slides for the material that I missed. I think I got most of the technical and complex components that I wanted to make sure I touched on tonight. We are at time. Before we leave, are there any questions that I need to answer about the exam or anything else? Okay, well then, thanks, gang. I will see you. I believe our syllabus has us in class again next week because I have to be gone the following week. So I switched it up so we'd go back to back on ground and then we'll go back to back virtual. So I'll see you here next week. Good, thanks all.
Thank you.
Thanks, Zoom, bro. Good night.